Okay, today we are diving into a topic that honestly is a really big deal for any small business owner: handling your partnership expenses. And look, getting this right isn't just about tidy bookkeeping. It's about building a financial shield for your business and for you. So let's just get right to it. The question that's probably floating around in your head: could the way you're handling expenses as a partner actually get you audited? Well, the short answer is yeah, it absolutely can. But don't you worry, because today we're going to walk through exactly how to turn that risk into a rock-solid defense. All right, to figure out the right way to do things, you first have to really understand the problem. And for business partners, it all starts with a very specific risk that's kind of baked right into the way partnerships are set up. See, here's the heart of the matter. As a partner, you're wearing two hats at the same time. You're an owner of the business, of course, but in the eyes of the taxman, you're also considered self-employed. And that's the dilemma. The business has its expenses, but you might be the one paying for them out of your own pocket. It's that confusion, who pays for what, who deducts what, that really creates all the risk. Okay, so we know partners are in a unique spot. Now, let's talk about the most common and, frankly, the most dangerous mistake people make when they're dealing with all those expenses. Let's make this real. Picture this. You're a partner, and you pay for a big business trip yourself. You put the flights, the hotel, the whole shebang on your personal credit card. Now, the first thing you think to do is just deduct it on your personal tax return, right? Seems logical. But that one simple step, that's the mistake that can kick off a world of trouble. So this leaves you with two paths you can go down. On one side, you've got the risky path. That's where you deduct that big business trip on your personal return, usually on something called a Schedule C. To the IRS, seeing a bunch of big expenses on a personal form like that, it just looks suspicious. It's a red flag. But on the other side, you've got the secure path. This is where the partnership itself handles the expense through a formal, documented plan. It's so much cleaner, safer, and way, way easier to defend. So, we've seen the problem, we've seen the common mistake. That brings us to the hero of our story today, the smart and actually pretty simple solution. After looking at that risky path, the question is pretty obvious, isn't it? What is the right way to handle that business trip expense? How do you make sure you stay on that secure path? And the answer is to use the partnership's accountable plan. So what is that? An accountable plan is basically just a formal, written-down set of rules for how the business pays partners back for business expenses. This is not a handshake deal, okay? It's a real policy, something you write into your partnership agreement that proves these are legit, pre-approved business costs. It's the official and the safest way to do it. But why, though? Why is this accountable plan so much better? What's it actually doing for you? Well, it builds up your defense with 4 very specific protections. That's right, 4. Think of them as 4 layers of protection. Each one plugs a hole that could otherwise attract an audit. Let's break them down. All right, let's walk through these. First up, proper treatment. The expense gets logged on the partnership's books, where it belongs, not yours. That proves it's a business cost right from the get-go. Second, you avoid red flags. This is a big one. That huge travel expense is no longer showing up on your personal tax return, which gives an auditor one less reason to get curious. Third, you get central docs. I mean, just imagine an audit. Instead of you digging through a shoebox full of receipts, the partnership just provides one clean, organized file. It's professional, it's defensible. And finally, consistency. The plan makes sure every partner follows the exact same rules. That proves these are real business expenses, not just some disguised personal perk for one person. So let's pull all of this together now. The big takeaway here is that this isn't really about accounting. It's about protection. It's about your shield. And ultimately, it all comes down to this. When you use it the right way, your partnership is so much more than just a legal entity on a piece of paper. It's your financial shield. By making sure all your expenses flow through a formal, accountable plan, you transform your business structure from a potential source of risk into your very first line of defense. And that leaves us with one last question. And this one's for you to think about. Take a really honest look at how you and your partners are handling expenses right now. Ask yourself, is your current plan a strong shield, clearly documenting and defending your business costs? Or is it maybe leaving you and your business a little exposed? The answer to that question could make all the difference.
Thanks for joining us for The Explainer.